Welcome to the Deep Dive. Today we're going to explore a really interesting avenue for startup funding, family offices. Now, you're probably familiar with venture capital funds. They pool money from various investors looking for high-growth companies and, a relatively quick exit.
Right, the standard model.
A family office is different. It's a private organization set up by a wealthy family to manage their assets across generations.
Yeah, I think investments, tax planning, maybe even philanthropy, it's a much more sort of personal and often longer-term approach to wealth management.
Exactly. And the source we're diving into today is a prompt titled Raising Startup Funding from Family Offices, which you can find on 4irgpt.com.
And big thanks to the prompt creator for putting together such a comprehensive overview. It's really detailed.
It is. Our goal for you today, the listener, is to really help you wrap your head around family offices as a potential funding source.
Yeah, we want to unpack some new methods, maybe strategies for connecting with them.
And give you actionable insights, hopefully without making it feel too overwhelming. Okay, let's get started.
Just before we dive right in, a quick word from our sponsors.
Yes.
This deep dive is supported by blockchaincompany.info, that's our media platform, and it's generously sponsored by 4IR Utility Token and 4RGPT.
Great sponsors.
Absolutely. To discover more about the whole 4IR utility ecosystem, you can head over to 4irtoken.com. And if you're interested in maybe monetizing your own expertise through creating prompts like the one we're using today, you can sign up over at 4irgpt.com.
Definitely worth checking out. All right, so let's dive into the core differences here.
Okay.
One of the key things to really understand is how a family office thinks about investments compared to, say, a venture capital fund. What are some of those fundamental distinctions?
Well, what's really fascinating here, I think, is their approach to time and their overall goals, right?
Time horizon, yeah.
Family offices generally operate with a very long-term perspective. We're talking often spanning generations.
Wow.
So their main aim is really to grow and, importantly, preserve wealth over decades. This lets them be much more patient with their investments.
Patient capital. You hear that term a lot.
Exactly. VC funds, on the other hand, they typically work within, a 7 to 10-year cycle?
Usually.
They're focused on generating high returns and exiting their investments relatively quickly within that time frame.
So that patience isn't just about waiting longer, is it? It probably unlocks different kinds of opportunities.
Oh, absolutely. It unlocks potential for startups pursuing maybe fundamentally disruptive tech or business models that just wouldn't fit the sort of rapid growth expectations of a typical VC.
Like deep tech or maybe some biotech.
Precisely. Think about a biotech company with a really long drug development timeline. That kind of venture might just be a much better fit for a family office's long-term view.
Okay, that long-term view sounds like a really significant difference. It's almost like planting a forest versus harvesting an annual crop, maybe.
That's a good analogy, yeah. And if we connect this to how they view risk and build their portfolios, we see another key distinction.
Okay, how does risk tolerance differ?
Well, family offices, while they might allocate a portion to higher risk, higher reward assets like startups.
Sure, some diversification.
Right. They typically balance these with more stable traditional investments. Their primary mandate, remember, is wealth preservation. So managing that overall risk is crucial.
Makes sense.
VC funds, in contrast, are basically built to take on significant risk. The expectation is that a few big successes, those home runs, will more than compensate for the inevitable failure.
The classic scheme model.
Exactly, the home run strategy. So while a family office might consider a startup investment, they're also thinking very carefully about its place within their broader strategy for preserving wealth across generations.
So a family office might be willing to take a calculated risk with a startup, but they're also going to be very mindful of the overall stability of their assets. That's interesting. How does this play out and how they actually make investment decisions? Who's calling the shots?
Well, that raises an important question about, who's making the decisions and what's influencing them.
Right.
In a family office, decisions are often heavily influenced by the family's personal values, their considerations for their legacy, maybe even goals that aren't purely financial.
So more than just ROI.
Definitely. They might invest in a company whose mission resonates with their philanthropic aims, for example, even if it doesn't project the absolute highest immediate return.
Okay. Oh, VCs.
VC funds, they tend to follow a much more defined investment thesis, right? very focused on potential financial returns and how easily a company can scale.
Driven by the LPs.
Exactly. Their decisions are driven by professional fund managers who are accountable to their own investors, the limited partners. So, yeah, there's often a much more personal element to the decision-making process with a family office.
That personal touch could mean a very different dynamic for a founder, I imagine.
Absolutely.
And I guess that also affects how much flexibility they might have in structuring the deals themselves.
Oh, absolutely, because family offices are managing, a single family's wealth and aren't as answerable to external investors for that short-term performance.
Right. No quarterly pressure in the same way.
Precisely. They can be significantly more flexible. They might pursue long-term illiquid investments or support businesses for strategic reasons that go beyond just pure financial metrics.
And VCs are more constrained there.
Well, VCs, while they can also be very supportive, usually operate within predefined mandates and have exit strategies geared towards creating liquidity events within the fund's lifecycle.
Okay, so that flexibility in deal structuring, what could that actually mean for a founder?
It could mean less dilution, potentially, or more customized governance arrangements that better suit the company's specific needs at that stage. Maybe more creative financing options overall.
Okay, so we're starting to get a much clearer picture of these fundamental differences. Now, thinking from the startup's perspective, why might an early-stage company actually prefer taking capital from a family office over a VC?
Well, that extended time horizon we just talked about, that's a major draw for many startups.
The patient capital again.
Yeah. That patient capital allows them to focus on sustainable development, maybe build a really strong foundation, without that constant pressure of hitting short-term milestones just to facilitate a rapid exit.
That sounds incredibly appealing, especially maybe for companies with a longer-term vision for impact or something like that.
Exactly. It can be particularly valuable for companies with complex technologies or, business models that just require more time to mature.
What other strategic advantages might there be?
The greater flexibility in deal structuring is another significant benefit we touched on. Unlike VC funds that often have fairly standardized terms and expectations around exits, family offices can just be more adaptable.
So less dilution again.
Yeah, potentially less dilution for the founders, maybe more tailored governance arrangements that better fit the company's stage and needs, or just more creative financing options overall.
Less dilution is always a welcome prospect for founders, isn't it?
Always.
And we touched on the alignment with vision and values earlier. How significant a role does that play here?
It can be huge. Family offices might choose to invest in startups that really deeply resonate with their personal values or their long-term legacy goals.
So it's more than just business.
It can lead to a much stronger alignment of interests, especially for founders who are driven by a mission that goes beyond just financial returns. It's about finding a partner who truly believes in what you're building on, maybe a more profound level.
Yeah, that shared purpose.
Right. It can create a more resilient and supportive relationship, especially when you hit those inevitable, challenging times.
That deeper level of understanding and support sounds like it could be invaluable. You also mentioned the pressure for a quick exit that often comes with VC funding. How does that differ when working with family offices?
Yeah, that pressure is often significantly lower with family offices. They tend to be more open to supporting maybe slower, steadier organic growth strategies.
So you don't have to compromise the vision.
Exactly. It allows the startup to really mature without having to compromise its core vision just to achieve a rapid acquisition or IPO within a specific fund's time frame.
So the focus shifts more toward long-term value creation rather than just a short-term gain for the fund.
That's a really compelling difference, yes. The focus can be much more on building a sustainable and impactful business.
What about the kind of support they typically offer beyond just the financial investment itself, the value add?
Well, family offices can often provide valuable operational and strategic support, plus access to their expensive networks, which can span various industries and geographies.
But maybe less hands-on.
Generally, yes. They usually exert less day-to-day control compared to VCs, who often take board seats and have more hands-on involvement in operational decisions.
So potentially more autonomy for the founders.
It can give founders more autonomy, yeah. More room to innovate and steer their company in the direction they believe is best. It's potentially guidance and connections without quite as much direct interference in the daily operations.
So it's a potential for valuable connections and insights without maybe the same level of intense oversight. That sounds like a potential sweet spot for many founders.
It can be.
But of course, relying on family offices isn't without its potential downsides or risks, is it?
No, definitely not.
What are some of the main drawbacks or risks compared to going with a VC?
Okay, one key area is potentially limited industry expertise and network within the startup's specific sector.
Ah, okay.
Family offices might not have that deep specialized knowledge or the extensive startup-focused networks or even the operational scaling experience that many VC firms bring to the table.
Right, VCs are often hyper-specialized.
Exactly. This could limit the very specific strategic guidance and introductions that founders might otherwise get from those sector-focused VCs.
That's a valid concern. VCs often have just a wealth of experience and connections within really niche industries. How can a startup mitigate that potential lack of specific expertise when working with a family office?
Well, founders can proactively address this. They can seek out external advisors or board members who do have that relevant industry expertise.
Bring in outside help?
Right. Partnering with accelerators, maybe industry-specific mentors, or even specialized consultancy services can also help fill those advisory gaps and provide that needed sector-specific knowledge.
That makes sense. Supplement the family office's broader perspective with more targeted expertise. What about the financial side? Are there risks related to follow-on funding in later stages?
That's another really important consideration. Unlike VC funds that often plan for multiple investment rounds within their fund lifecycle to support growth.
Right, they reserve capital.
Exactly. Family offices might have less predictable or maybe less structured approaches to follow-on investment.
Which could be a problem down the road.
It could create challenges if additional capital is needed as the company scales and hits future milestones. It's just not always built into their model in the same way.
So it might not be as reliable a source for those crucial later funding rounds. What proactive steps can a startup take to prepare for that potential uncertainty?
Well, it's crucial for founders to have really open and direct conversations with the family office about their potential for follow-on funding during the initial deal negotiations.
Get it on the table early.
Yes, maintaining transparent communication about progress, milestones, future capital needs that can also help manage expectations.
And maybe don't put all your eggs in one basket.
Absolutely. It's probably wise to consider diversifying your investor base right from the outset, even with a family office as a lead investor. It just provides more options for subsequent funding rounds.
Diversification seems like a prudent strategy, regardless of the initial funding source, really.
It largely is.
What about potential disagreements on the company's strategic direction down the line? Could that be a risk?
It can be, yes. This is where potential misalignment on strategic objectives can sometimes arise.
How so?
Well, as we said, family offices may have investment motivations rooted in personal or legacy considerations.
Right, the non-financial goals.
And these could occasionally diverge from the founder's core vision or perhaps their preferred management style.
And maybe pace expectations differ.
That too. Because family offices may not be as intensely focused on those rapid exponential growth metrics like VCs, there could be a mismatch in expectations regarding the desired pace of innovation or scaling.
So, personal passions or long-term family goals could sometimes influence business decisions in ways a more purely financially driven investor might not?
Potentially, yes.
How can founders navigate that potential complexity?
Clear and early alignment on strategic goals is absolutely essential. Founders really should proactively discuss and ideally document key expectations, governance structures, decision-making processes.
Get it in writing.
To ensure both parties share a common understanding of the company's direction right from the outset. And regular strategic reviews with open and honest communication can also help keep the relationship aligned and address any emerging differences over time.
Communication and clearly defined expectations seem to be recurring themes here, don't they?
They really are critical.
What's another potential drawback of working with a family office that founders should be aware of?
Well, family offices often operate with less formalized, maybe less standardized processes compared to institutional VC firms.
Less bureaucracy, maybe.
Right, but that can sometimes lead to slower decision-making timelines or maybe a lack of clear, established procedures for investment decisions and ongoing support.
So less structure can sometimes introduce uncertainty into the process. How can a startup best manage those less formalized approaches?
Founders can address these concerns by proactively establishing structured communication and reporting plans right from the beginning.
Set the cadence.
Exactly. It's important to clarify expected timelines for key decisions and to outline the levels of support and involvement that are anticipated throughout the company's life cycle.
And the term sheet helps here.
A well-defined and mutually agreed-upon term sheet can definitely help set clear expectations for both parties regarding processes and timelines.
Clear communication and proactive structuring seem to be the keys again. What's one last potential risk or drawback founders should keep in mind?
Just that the level of involvement and support from a family office can vary quite significantly.
That's not a given.
No. While some may be quite active, offering strategic guidance and leveraging their networks, others might take a much more hands-off approach compared to VCs who often actively participate through board seats and more intensive strategic involvement.
Which could leave a gap.
It could potentially leave founders with less operational or strategic support during critical growth phases.
So you might get the capital, but not necessarily the same level of active mentorship or operational assistance you might expect from a VC.
It's a possibility you need to assess.
How can a founder prepare for that potential scenario?
Well, during the due diligence phase, founders should really try to assess the level and type of value add that the family office is prepared to provide beyond just the capital.
Really dig into that.
Yes. If it seems like they'll be more passive, they might consider strategically combining that family office capital with other forms of investment, maybe angel investors with specific expertise.
Or build out the advisory board.
Exactly. Proactively building a strong advisory board can fill those operational or strategic gaps. Negotiating advisory roles or even board observer positions as part of the investment agreement can also be beneficial to ensure some level of ongoing engagement.
Okay, understanding the potential challenges is crucial for making an informed decision. Now, let's shift gears a bit.
Okay.
What are some key traits that really signal a family office might be a good match for a particular startup? What should founders look for?
Well, one of the most important indicators is their sector focus and demonstrated expertise.
Alignment with your industry.
Right. Look for family offices that have a history of investing in your startup's specific industry or in closely related markets. A clear track record or expressed interest in similar sectors suggests they'll likely have a better understanding of your market dynamics, your competitive landscape, potential challenges.
So they can offer more relevant guidance.
Exactly. They can offer more relevant strategic guidance beyond just the financial investment.
That makes perfect sense. They'll have a much better grasp of the nuances of your business. What about the typical size of their investments? The ticket size?
Yeah, the ticket size is key. It's essential to confirm that their typical investment range aligns with your current capital needs and your expected future funding requirements.
Because they vary a lot.
Considerably. Some focus on smaller, early-stage investments, while others participate in larger growth rounds. And crucially, inquire about their willingness and capacity to participate in potential follow-on funding rounds.
Circling back to that follow-on risk.
Yes, because that long-term financial commitment can be critical for your scaling plans.
So, making sure their investment appetite matches not just your immediate needs, but also your longer-term funding trajectory. What about their geographical focus or preferences? Does location matter?
It can. Geographic alignment can also be a significant indicator of a good match. A family office with a focus in your startup's region, or at least a willingness to invest outside their immediate geographic base.
What's the benefit there?
Well, they can provide valuable regional market knowledge, local networks, and potentially just easier access for ongoing collaboration and support. Family offices with a regional focus might also have a deeper understanding of local regulations, talent pools, things like that.
Local knowledge and networks can definitely be a powerful advantage. What's another key trait to look for at a potential family office partner?
We touched on this earlier, but shared values and vision are really critical for a successful long-term partnership.
The alignment piece again.
Yes. Family offices often invest based on deeply held personal or legacy considerations. If you can identify a family office whose core values, like a commitment to long-term sustainability, maybe a focus on social impact, or adherence to specific ethical business practices strongly align with your startup's mission,
That's a strong foundation.
it can create a very strong and resilient foundation for your relationship. Make sure their overall investment philosophy and their vision for the future resonate with your company's core principles.
So it's really about finding an investor who believes in more than just the potential financial return. It's a shared ethos, maybe.
I think that's a great way to put it, a shared ethos.
What's one last key trait that can signal a strong potential fit?
Look closely at their decision-making approach and their demonstrated flexibility.
How they operate.
Yeah. Family offices that operate with a more flexible process and are open to structuring investment deals tailored to your specific growth stage and unique needs can be an excellent match, particularly in the often fluid early surges of a startup.
And look for that patience.
Definitely. See if they have a reputation for taking a patient capital approach and for supporting their portfolio companies through strategic challenges, rather than just demanding immediate, rapid exits. Open and transparent communication about their investment horizons and decision-making timelines also indicates a willingness to engage closely and collaboratively.
Patience and flexibility. Those certainly sound like highly desirable qualities in a long-term investment partner.
Absolutely.
Now, how can a founder quickly get a sense of whether their business model and mission genuinely align with the family office's legacy or impact agenda? Because it's not always immediately clear from their public profile, is it?
No, it often isn't. But there are several effective ways to gauge this early on. First, you've got to do your thorough homework.
Research, research, research.
Exactly. Researching their family history, any public statements or philanthropic activities they've been involved in, and definitely their past investment portfolio. Look for consistent patterns in the values they seem to prioritize and the types of causes or initiatives they have historically supported.
So look at their track record and what they actively support, not just their stated aspirations.
Precisely. Actions speak louder than words here. Second, conduct a critical self-assessment of your own mission.
Look inwards.
Right. Identify the core impact and legacy elements of your business. Then, try to map your mission and long-term vision directly against the family office's apparent priorities. Are you both focused on similar areas? Sustainable development, social change, ethical innovation?
Find the overlap.
And be ready to clearly articulate any non-financial achievements or metrics that demonstrate your commitment to values that might resonate deeply with them.
Essentially, find where your why and their why intersect.
That's a great way to think about it. Third, proactively prepare an impact-focused narrative.
Tailor the story.
Yeah. Craft a concise and compelling pitch that explicitly outlines how your business model is designed to generate long-term positive change and aligns with the family office's stated heritage or demonstrated values. Emphasize how your company's growth isn't solely about short-term financial gains, but also contributes to sustainable, measurable, long-term benefits.
So weave the story of your impact right into your core pitch. What's another effective way to quickly gauge this crucial alignment?
Fourth, don't hesitate to ask targeted questions directly during your initial discussions.
Be direct.
Yeah, but thoughtfully. For example, you could ask something like, we're very focused on long-term sustainability. Could you share some examples of initiatives your family has supported that reflect your commitment to environmental responsibility?
Okay.
This shows your genuine interest in their values and also provides early direct insight into their specific priorities.
Direct and purposeful questioning a valuable strategy. What's one final practical way to test for this crucial alignment early in the process?
Leverage your professional network and trusted advisors.
Tap the network.
Exactly. Talk to individuals in your network who have prior experience working with family offices or who have insights into the specific family office you're targeting. They can often provide invaluable insider perspectives on the family's core values, investment preferences, and what truly matters to them beyond the surface level.
And maybe talk to other founders they've backed.
Absolutely. If possible, seek feedback from founders who have previously partnered with them. Their firsthand experiences can be incredibly helpful in understanding potential areas of alignment or, misalignment.
So tap into the collective wisdom of your network to gain those valuable firsthand insights. That's a smart approach.
Definitely worth the effort.
Now, let's shift to the practical side of things. Actually finding these potential family office partners. What are some useful resources, both free and paid, for building a targeted list?
Okay, there are actually quite a number of valuable resources available. On the free side, LinkedIn is an excellent starting point.
LinkedIn, okay.
Utilize advanced search filters with relevant keywords like family office, private wealth management, specific industry terms. Join relevant groups, actively engage in discussions.
What else?
Crunchbase and AngelList, even their free tiers, can sometimes provide information on family offices that have invested in early-stage companies. They're often tagged with investment preferences.
Worth a look.
Also, keep an eye out for publicly available lists of top family offices published by reputable financial media outlets like Barron's, Bloomberg, Forbes. You can often find these online.
Those top XX lists.
Exactly. And don't overlook industry-specific blogs, newsletters, digital magazines that occasionally publish free direct directories, or overviews of family office activity in particular sectors.
So some strategic digital research can yield some initial promising leads without breaking the bank.
For sure.
What about paid resources for a more comprehensive and targeted search,
Yeah.
if you have the budget?
For more in-depth data, verified contact information, and advanced search capabilities, subscription-based databases like PitchBook, Prekin, and FindTRX are extremely valuable.
What do they offer?
These platforms often provide detailed profiles of family offices, their investment history, specific areas of interest, even contact details for key personnel. Much more granular detail.
Okay. Any other paid options?
There are also paid membership networks like the Family Office Club and Family Office Exchange, or FOX. These offer access to exclusive networks, proprietary research, and networking events.
Events could be key too.
Definitely. Don't underestimate the value of attending family office conferences and forums, like those hosted by organizations like Opal Group, as well as other big investor-focused conferences that often have family office participation.
So the paid options offer more granular data, direct networking opportunities, and deeper market intelligence overall.
Generally, yes.
What's the most effective way for someone to strategically combine these free and paid resources for maximum impact? You probably don't need everything.
No, probably not. The most strategic approach is often to start by leveraging the free resources. Build an initial, broader list of potential targets, get a general understanding of the landscape.
Start broad and free.
Right. Once you have that foundational list, then, if your budget allows, you can utilize the paid databases to conduct more targeted searches based on your specific criteria, verify the information you've gathered, and get those deeper insights and contact details.
And layer in the networking.
Absolutely. Attending relevant industry conferences and forums is invaluable for that face-to-face networking and for validating the information you've uncovered through your research. And if you're serious about building long-term relationships, consider the paid membership networks for ongoing access to exclusive communities and market intelligence.
That's a really practical, tiered approach to resource utilization. Start free, layer in paid data, then network strategically.
Exactly.
Now, let's say a founder wants to get very focused and build a list of really high probability prospects. Can you outline a sort of, 10-step desk research method they could follow to identify, say, 50 promising family offices within maybe a couple of weeks?
Okay, yeah, we can structure that. Here's a possible methodology.
Step 1.
First, clearly and precisely define your ideal prospect profile. Be super specific about their preferred investment stage, historical sector focus, typical ticket size, geographic preferences, and any stated values or impact areas that align with your mission. Get that target clear.
Got it. Define the ideal. Step 2.
Compile a comprehensive list of relevant keywords and search phrases. Think broadly. Impact investing, legacy capital, specific industry niches, terms they might use.
Keywords. Step 3.
Begin systematically searching those free online directories and publications we mentioned. Look for the top family offices lists, reports on impact investors, any public databases. Start building a preliminary spreadsheet.
Gather initial names. Step 4.
Leverage LinkedIn's advanced search. Filter by job titles like CIO, investment manager, principal, combine with your keywords. Explore profiles, note backgrounds, stated interests, join relevant groups.
LinkedIn Deep Dive. 5.
Explore the free tiers on Crunchbase and AngelList. Search for investments by family offices and companies similar to yours. Look at who invested and any info on their preferences.
Crunchbase AngelList mining. 6.
Identify and bookmark leading industry blogs, newsletters, expert publications covering family office activity. Look for free directories, lists, articles mentioning specific offices and their focus.
Follow the experts. 7.
If you have access to paid databases like PitchBook or FindTRX, now use their advanced filters. Filter by stage, sector, geography, deal size, impact interest, export the data.
Paid database filtering. 8.
Cross-validate everything. For each office identified, check info across multiple sources, their website, press releases, LinkedIn profiles, news articles. Ensure accuracy, refine your understanding.
Validate and verify.
9. Look at conference attendee lists. If you know of relevant family office or investor events, review public attendee or speaker lists. Identify potential fits and add them.
Conference lists. And finally, 10.
Organize everything in your spreadsheet. Include name, contact info if found, investment preferences, notes on mission alignment, your initial probability assessment, then prioritize your outreach based on that assessment.
That's an incredibly structured and actionable approach to building a targeted list. Very helpful.
It takes effort, but it pays off.
Now, once you have that list, How do you actually initiate contact? Warm introductions are generally considered the most effective route, aren't they?
Oh, absolutely. A warm intro is gold.
So how can founders strategically leverage their networks, lawyers, bankers, maybe even CEOs of other portfolio companies to secure those valuable warm introductions?
Yeah, those are key network segments. Let's look at how to approach each.
Okay, lawyers first.
Corporate lawyers, especially those in M&A, venture capital, or who work with high net worth individuals, often have established relationships. When reaching out to a lawyer in your network, emphasize any shared values or mutual connections to build rapport first.
And the script. What might you say?
Something like, "Hi, lawyer's name. Hope you're well. Knowing your work with family offices in the specific industry space, I wanted to reach out. My startup, your company, is developing brief solution description, and we're seeking mission-aligned long-term investors. Given your network, I was hoping you might offer guidance or potentially connect us with a relevant family office."
Okay, polite, specific, clear ask. What about bankers?
Investment bankers, private bankers, they often work closely with family offices on wealth management and investment strategies. When you connect, position your startup not just as a growth opportunity, but also as a potential legacy investment.
Angle it towards their interests. Script example.
Maybe. "Dear banker's name, I'm your name, CEO of your company, an impact-driven tech startup in your sector. I understand you advise family offices who value sustainable, legacy-focused investments. We believe our mission and brief description would be a strong fit, and I'd be grateful for your insights or an introduction if you see potential alignment."
Again, clear and tailored. What about portfolio CEOs? People who've already raised from FOs.
Those can be incredibly valuable intros. CEOs who've successfully raised from family offices have firsthand experience and connections. When reaching out, express admiration for their journey, mention their FO partnerships specifically.
Build rapport first.
Right. Then politely ask if they'd be open to a brief chat about their experience and if they might see a fit for your startup.
Sample script for that.
Try. "Hi, CEO's name. I've been following their company's growth, particularly your fundraising with family offices. At your company, we're building brief description and believe long-term mission-driven investors could be ideal. I'd be incredibly grateful for any insights on your experience, and if you see a potential connection, we'd certainly value an introduction."
Okay. And general tips for all these.
Be clear and concise about your value and alignment. Keep messages brief and personalized. Always follow up politely if you don't hear back in about a week or so.
Excellent. Very practical outreach scripts. Now, let's say you've secured that initial meeting. Fantastic.
Big step.
What should your pitch deck look like when you're presenting to a family office? Are there specific elements or a particular emphasis they'll be looking for, different from a VC pitch?
Absolutely. A well-structured, maybe 12-slide deck tailored to family office expectations should strategically blend key business info with a significant emphasis on your long-term vision, the positive impact you aim to create, and how your mission aligns with their potential legacy goals.
Okay, walk us through the slides. Slide 1.
Cover slide. Compelling logo, tagline, presenter info, maybe a visual hinting at long-term vision and impact.
Slide 2. Crucial one, you said.
Yes, vision and legacy. Clear overview of mission, long-term vision, emphasize core values. Explicitly link how your venture contributes to broader positive impact and the kind of lasting legacy they might want to support.
Got it. Slide 3.
The problem. Define the market need or pain point. Where relevant, highlight how it aligns with larger societal challenges or opportunities for positive change.
Slide 4.
The solution. Describe your product service, key benefits, and importantly, its long-term sustainable impact. Use compelling visuals.
Slide 5.
Business model and value proposition. How you make money achieves sustainable growth. Beyond financials, highlight non-financial value, community benefits, environmental advantages, etc.
Slide 6.
Market opportunity. Size, trends. Emphasize segments focused on sustainability, impact things that resonate, competitive advantages, differentiators.
Slide 7.
Traction and key milestones. Achievements to date, key partnerships, relevant growth, or impact metrics demonstrating progress and long-term potential.
Slide 8. The other really vital one.
Impact and legacy alignment. Yes. Clear, compelling overview of social environmental impact, ideally with measurable KPIs. Explicitly link your mission and impact goals to the potential legacy and values of this specific family office. Concrete examples are key here.
Slide 9.
Financial projections and ROI. High-level 3 to 5 year forecasts, but frame ROI within the context of long-term sustainable value creation. Explain key assumptions, how strategy supports viability.
Slide 10.
The team and advisory board. Highlight relevant experience, expertise, shared values. Feature advisors, especially those with FO or impact backgrounds.
Slide 11.
Investment proposition and use of funds. The ask. Clear funding amount, rationale, detailed allocation plan to accelerate growth and impact. Reiterate long-term vision. Briefly touch on exit scenarios, but frame them in terms of sustainable, multi-generational value.
And finally, slide 12.
Summary and next steps. Recap key takeaways, mission, impact, alignment. Clear call to action like scheduling a follow-up. Express appreciation for their consideration of your long-term vision.
That's a very comprehensive outline, clearly emphasizing the elements likely to resonate with that family office mindset.
Exactly. It's about telling the right story for that audience.
What about a really concise way to initially introduce your company and its core values? Should founders consider having something shorter, like a one-page teaser, for that initial outreach?
Oh, absolutely. A well-crafted, one-page values-first teaser can be incredibly effective for capturing initial interest and quickly communicating your core mission and its connection to that multi-generational perspective.
What should be on it?
Start with a compelling overview of your mission, explicitly emphasizing sustainable growth, contributing to multi-generational well-being. Clearly state your vision and mission, ensuring they highlight long-term impact and legacy.
Values section.
Definitely. Outline your core values: integrity, sustainability, social impact, innovation, whatever they are. Crucially, include a section on strategic alignment with a multi-generational legacy. Show you understand their values, how you bridge past future with long-term impact.
And why you?
Briefly explain why your startup is compelling impact-driven innovation, track record, or potential. And finally, clear next steps, inviting a brief introductory conversation.
So it acts as a concise, values-centric introduction, designed to pique their interest and signal that potential alignment right from the first touch point.
Exactly. It sets the right tone immediately.
Now, when founders do get those initial meetings, what are some of the common questions a family office investment team will likely ask? And what's the best way to approach answering them to build trust and demonstrate that alignment?
Okay, good question. You can anticipate questions delving into the personal inspiration behind your mission and long-term vision.
The why.
Yeah. When answering, emphasize the core values driving you and the kind of enduring legacy you hope to create. They'll likely inquire about the sustainability and long-term growth potential of your business model.
The how.
Be ready to detail revenue streams, scalability plans, risk mitigation strategies, always focusing on building enduring value. Expect questions about your market opportunity and competitive advantages.
Positioning.
When discussing this, make sure to highlight aspects specifically addressing impact investing trends or aligning with broader legacy considerations. They will also likely ask about key risks and mitigation plans.
Be upfront about risks.
Yes, be honest and transparent, but demonstrate a thoughtful approach to long-term stability.
Transparency and a long-term focus seem key. What else should founders prepare for?
They'll likely want to understand precisely how you plan to measure both financial performance and social environmental impact.
Metrics for both.
Be ready to explain KPIs, your commitment to transparent reporting that aligns with their potential legacy values. Be prepared to thoroughly discuss your team's qualifications.
Why this team?
Highlight relevant expertise, experience, any shared commitment to core values. They'll also likely ask how a partnership with a family office specifically would enhance your strategy.
Why them?
Emphasize the benefits of their patient capital, potential for shared values-driven collaboration, any complementary expertise or network access they might offer. Finally, be prepared to discuss your long-term vision for value creation and potential exit strategies.
So frame it carefully.
Right. Frame exits within the context of building a sustainable, multi-generational enterprise, not just short-term gains. The key throughout. Be authentic, concise, yet informative. Consistently highlight commitment to both financial success and legacy impact goals. Use data. Be ready with specific examples.
That's excellent preparation for navigating those crucial initial conversations. Now, let's think about the outreach process itself, that whole journey.
Okay.
Can you outline a structured, maybe 30-day plan from that initial email contact all the way through to potentially securing a live demonstration with key decision makers at a family office?
Absolutely. A 30-day plan like this integrates personalized outreach, consistent follow-up, and strategic engagement. Let's break it down week by week.
Okay, week 1.
Week 1. Research, introduction, and first outreach. Finalize your target list. Craft highly personalized initial emails articulating that values-first mission and potential alignment. Send them. Make initial LinkedIn connections. Engage with their content subtly. Prepare a gentle follow-up template. Maybe make a few initial intro calls if appropriate.
Laying the groundwork. Week 2.
Week 2, nurturing and building interest. Follow up with non-responders. Make more direct personal calls where appropriate. Actively leverage any warm intros secured. Keep engaging on social media with valuable content. Send a second, different follow-up email to those still unresponsive. Aim to schedule initial discovery calls with interested parties.
Ramping up engagement. Week 3.
Week 3, discovery and pre-demo engagement. Conduct those discovery calls, actively listen to understand their priorities. Follow up promptly with customized materials. Refine your demo invitation based on these talks. Send out personalized demo invites highlighting value for them. Send soft reminders to RSVP'd folks. Maybe schedule second, deeper calls with highly interested prospects.
Deepening the conversation. Week 4.
Week 4, live demo execution and final engagement. Host your live demos engaging, tailored. Send immediate personalized follow-ups after each. Reinforce value with social proof, testimonials, press. Host additional tailored demos if needed. Schedule one-on-one follow-ups with the most promising prospects to discuss terms. Send a final follow-up to unresponsive but potentially good fits. Gather feedback constantly. Leverage any new warm intros. Send a final recap email to demo attendees. Offer a final chance for calls. Summarize the cycle. Plan next steps.
Wow, that's intensive. Key takeaways for that whole month.
Personalization is critical. Consistency in follow-up. Persistent, not annoying. Multi-channel approach. Diligent follow-up. Listen and adapt constantly. Always add value and show you understand their goals.
That's an extremely detailed and actionable outreach plan. Very thorough. Now, what about crafting that initial cold email to a busy CIO maybe? Can you give us a concise 2-paragraph template, emphasizing legacy, clear call to action for a brief call?
Okay, here's a concise template.
Legacy-aligned investment opportunity in your industry, your company name. Dear CIO name, my name is your name, and I'm the CEO of your company name. A mission-driven startup focused on creating sustainable and impactful solutions in your industry. We understand family office name's long-standing commitment to mention a specific area of known interest impact, if possible, and believe our approach to briefly describe core business and impact aligns strongly with these values. We are building not just a successful business, but a lasting positive impact in mention area of impact, something we believe resonates with a multi-generational perspective. I would be grateful for the opportunity to schedule a brief 15-minute introductory call to explore how your company name's vision for long-term value creation and positive impact could be a compelling addition to your investment portfolio. Would you have any availability in the coming week for a quick discussion? Best regards. Your name, your title, your company name, contact info.
Short, focused, values first, clear ask. Excellent. Now, thinking a bit more creatively, what are 3 distinct types of door opener events, maybe beyond standard one-on-one meetings, that might effectively engage family offices and spark their interest?
Okay, 3 creative event concepts. First, a legacy and impact innovation roundtable. Small, exclusive, invite only, maybe after a private dinner. Invite select family office principals, maybe a few thought leaders in your impact area. Facilitated discussion or brief presentations on trends in mission-aligned investing, legacy building, fosters peer exchange, positions you well.
Intimate and high level. Okay, second.
An interactive impact showcase and demonstration luncheon. Host a private, interactive webinar specifically for FOs, concise overview of mission impact, live demo highlighting benefits, long-term change. Then follow up the virtual showcase with an exclusive in-person demonstration luncheon in a key location. Allows personal interaction, hands-on demo, continues the values-first focus.
Virtual then physical. Got it. Third.
A next-generation family wealth and innovation summit. Half-day or full-day workshop retreat. Upscale venue. Target the rising generation within FOs, who are often very interested in impact and innovation. Feature expert speakers, interactive sessions on trends, curated networking. Builds relationships with future decision makers, positions you as forward-thinking.
Those are all very innovative approaches, moving beyond just the traditional pitch format. I like those.
Yeah, try to stand out a bit.
Now, let's delve into the specifics of investment structures. For a first-time founder navigating this world, terms like safe, convertible note, preferred equity can be quite daunting.
They can be, yeah.
Can you provide a clear comparison of these instruments, specifically within the context of a family office investment, highlighting pros and cons for both founder and investor?
Certainly. Let's break them down. First, the SAFE, Simple Agreement for Future Equity. Designed for simplicity, speed.
Pros for founders.
Less complex, less costly to negotiate usually. No interest, no maturity date, less immediate pressure. Flexible conversion terms, typically tied to a future funding round.
Cons for founders.
Lack of upfront valuation means uncertainty on eventual ownership percent. Conversion terms might not always be favorable. Later potential for more dilution. Less built-in investor protection.
Pros for the family office.
Simplicity, speed, no immediate valuation needed. Flexible way to invest early without full equity round complexities. Conversion aligns their upside with future success.
Cons for them.
Less immediate control or governance rights than equity. Uncertainty on timing valuation of conversion. Fewer built-in protections if things go south.
Okay, that's the safe. What about the convertible note?
Essentially, a short-term loan that converts into equity later, usually triggered by a future equity round.
Founder pros.
Allows raising capital without immediate valuation, good for very early stage. Often includes an interest rate, a small reward for early investors if things take longer.
Founder cons?
Accrued interest and potential maturity date can create pressure if another round isn't raised in time. Negotiating terms like valuation caps, discount rates can still be complex.
Family office pros.
Debt-like instrument with potential equity upside. Interest provides a small return while waiting. Valuation caps and discounts offer some downside protection and upside leverage on conversion.
Family office cons.
Requires more negotiation than a safe. Risk the note needs repayment if no further equity is raised.
Right. And finally, preferred equity.
This involves the direct sale of equity shares, granting investors certain rights and preferences over common stockholders, like the founders.
Founder pros.
More direct, established form of investment. Valuation determined upfront clarity on ownership. Can bring more engaged investors offering strategic guidance.
Founder cons.
Typically more complex. Costly to negotiate due to investor protection clauses, liquidation preferences, anti-dilution. Requires upfront valuation challenging early on. Can mean more immediate founder dilution.
Family office pros.
Strong investor protections. Governance rights, often board representation. Clarity on ownership, liquidation preferences. More direct participation in company performance and strategy.
Family office cons.
More complex, time-consuming to negotiate. Requires upfront valuation, which carries risk.
So, in the FO context, which is more common? Or does it vary?
It varies, but their longer-term view and focus on wealth preservation might make them more inclined towards understanding preferred equity terms, even early, for those protections. However, they might also like the simplicity of safes or the hybrid nature of notes, depending on risk tolerance and the specific deal. The key for founders is understanding the implications and articulating why a structure fits both needs.
That's a really clear and helpful breakdown. Are there any specific founder-friendly terms beyond just the instrument type that can be particularly appealing to family offices while still protecting founders? Finding that balance, right?
Absolutely. Finding that balance is key. Several terms can work. Valuation bands with flexibility can be attractive.
How does that work?
Instead of a fixed pre-money, agree on a range, a floor and a cap may be tied to achieving certain milestones. Protects investors, allows founders to benefit from exceeding expectations.
Okay, what else?
Offering observer seats on the board. Gives FOs valuable insight into strategy and progress without full voting control. Provides oversight without hindering founder autonomy too much.
Makes sense. Anything else?
Including co-invest rights and preemptive opportunities. Allows FOs to maintain their pro rata ownership in future rounds if they choose. Shows their continued belief without obligating them. Gives founders more predictability in future fundraising. These terms aim for that win-win.
Got it. What about for startups, specifically in the Web3 space? Is there a strategic way to bundle traditional equity with newer instruments like, say, token warrants or revenue share notes? Could that make an investment more attractive to an FO exploring this area?
Yes, that can be a very innovative and potentially attractive approach for Web3 startups engaging with family offices.
How would that work?
You bundle traditional equity, which represents ownership in the company itself, with maybe token warrants.
What are those?
They give the investor the right to acquire future tokens at a predetermined price after your token generation event, or TGE. This aligns their incentives not just with the company's equity upside, but also with the potential growth of your specific token economy.
Interesting. And revenue share notes.
Offering revenue share notes can provide investors with a more near-term potential return based on a percentage of your future revenue. That can be really interesting if your platform or protocol has early traction.
But documentation must be key here.
Absolutely crucial. When considering these bundled approaches, you need extremely clear, legally sound documentation outlining the mechanics of conversion for both warrants and revenue share notes, any vesting schedules, and the governance implications of both the equity and token holdings. Transparency and clarity are paramount.
So offering a stake in both traditional growth and the Web3 ecosystem upside, but with crystal clear documentation.
That's the idea.
Now, shifting back a bit. When it comes to due diligence, what kind of legal and compliance documents will a family office typically expect to see before they invest? And how should a startup best prepare these materials?
Okay, yeah, due diligence prep is vital. Family offices will expect a comprehensive and well-organized set of documents.
Oh, legals.
Typically, your certificate of incorporation or similar formation docs, shareholder agreement or operating agreement, your cap table, detailed ownership record, minutes from board and shareholder meetings, all relevant intellectual property documentation, patents, trademarks, copyrights, and any material contracts with customers, partners, vendors.
And on the compliance side?
They'll want to review up-to-date financial statements, ideally audited if available. Any necessary licenses and permits, your data protection and privacy policies, especially if you handle user data, cybersecurity policies, overall risk management policies.
So how best to prepare?
Ensure all these records are current, accurate, and readily accessible in a well-organized, secure virtual data room. It's also highly advisable to have your legal counsel review everything beforehand to ensure it's in good order and address any potential issues proactively. Being well-prepared and transparent builds trust and shows professionalism.
Being organized and having all your ducks in a row sounds crucial. Once the investment is secured, the partnership begins. What's a good rhythm for post-investment communication to keep the family office engaged and informed over the long term?
Establishing a consistent and transparent communication rhythm is essential for nurturing that strong long-term relationship.
What should that look like?
Typically, regular monthly or quarterly updates. Provide a clear snapshot of key financial KPIs, highlight significant milestones achieved. Maybe consider more in-depth quarterly or semi-annual reports, deeper dive into strategy, challenges, future plans.
FaceTime important.
Where appropriate, organize periodic insight days or in-person meetings, maybe annually or biannually. Give a comprehensive overview, conduct demos, foster direct interaction.
And leveraging data.
Yeah, create custom dashboards where investors can track key metrics, both financial performance and your stated impact goals. Look for opportunities to involve them in relevant joint projects or collaborations, aligning with their interests or expertise.
And definitely an annual review.
Certainly. Conduct a comprehensive annual strategic review. Discuss the past year, outline plans, specifically address how progress aligns with their long-term legacy and impact objectives. Openness, transparency, proactive communication, key to maintaining engagement.
It's really about building a true partnership through consistent, meaningful communication, not just sending periodic updates.
Exactly. It's a relationship, not just a transaction.
Can you share some real-world examples, maybe anonymized, of how founders have successfully leveraged a family's broader assets like media connections, tech resources, retail networks for significant strategic growth beyond just the money?
Oh, absolutely. There are numerous compelling examples. Imagine a direct-to-consumer sustainable fashion startup. They partner with an FO that has significant holdings in retail. They might gain invaluable insights into supply chain optimization, merchandising, maybe even access to prime retail spaces or pop-up opportunities.
Huge advantage. Another example.
An ed tech company could leverage an FO's philanthropic arm, which often has established relationships with educational institutions, to pilot their technology and gain crucial credibility and market access.
Using their network.
Right. Or a Web3 gaming platform might benefit immensely from an FO, with investments in media and entertainment, access to marketing expertise, content creation resources, introductions to key gaming influencers.
Clean tech example.
A startup developing innovative energy storage could find strategic value partnering with an FO holding assets in energy or infrastructure, potential pilot projects, valuable industry connections. The key is for founders to proactively identify potential synergies during due diligence and then actively cultivate those relationships post-investment.
So it's really about looking beyond just the capital and seeing the potential for a truly strategic alliance from the start.
That's where the real magic can happen sometimes.
Now, for first-time founders venturing into this world, what are the top, say, 5 common mistakes they often make when pitching family offices? And what practical advice can help them avoid these pitfalls?
Okay, 5 common mistakes.
Overlooking the unique perspective of a family office and treating them just like VCs. Avoid this by doing thorough research on their specific values, history, impact focus, and tailoring your pitch to highlight long-term impact and legacy alignment, not just short-term ROI.
Mistake 2.
Failing to proactively identify and leverage potential strategic synergies with the family's broader assets. Address this by specifically outlining in your pitch how their network or resources could directly benefit your company's growth and impact.
3.
Inadequate preparation for due diligence. Avoid this by having all your legal, financial, compliance docs organized, up to date, and ready from the outset in that data room. Neglecting to outline a clear post-investment communication strategy. Avoid this by proactively presenting a plan for regular, transparent updates showing you value the partnership beyond just the check.
And number 5.
Especially for tech or Web3 startups, overcomplicating the equity structure and financing terms. Keep proposals as simple and transparent as possible. Clearly articulate the value proposition and incentive alignment.
Those are incredibly valuable insights for anyone approaching family offices for the first time. Really practical.
Hopefully helpful.
Now, what if, despite a founder's best efforts, that initial outreach just isn't gaining traction? It happens. What's a good contingency plan? Alternative funding avenues, different partnership strategies.
Yeah, if outreach stalls, it's crucial to have well-defined backup plans.
Yeah.
Immediately consider exploring alternative funding sources,
Like
traditional VCs, angel investors, strategic corporate investors who might have specific interests, even government grants, incubator accelerator programs for non-dilutive capital and mentorship.
and other partnerships.
Simultaneously, explore strategic partnerships, co-branding, joint ventures, industry consortiums. These can provide market access, validation, maybe lead to future funding.
Revisit the pitch.
Don't be afraid to critically adjust your pitch based on feedback. Maybe simplify terms, broaden your search to FOs with slightly different focuses, and consider bridging financing options, convertible notes, short-term loans to maintain runway while you reassess.
It's about staying agile, exploring all avenues, and being prepared to adapt.
Absolutely. Resilience is key.
Now, to bring all of this together and make it really tangible for our listeners, can you paint a picture for us? Maybe a brief breakdown of a successful, say, $3 million seed funding round led by a family office. Touch on timeline, key deal terms, ultimate outcomes.
Okay, let's imagine a mission-driven health tech startup. They spend about 2 months on deep research, identify maybe 100 FOs interested in healthcare innovation and impact, prepare their diligence materials meticulously.
Research phase. Then outreach.
Over the next 6 to 8 weeks, they execute that targeted outreach strategy, warm intros where possible, refining the pitch based on feedback. By month 4, they get a promising term sheet from an FO aligned with their long-term vision for patient outcomes.
Diligence time.
Next 6 weeks are comprehensive due diligence, both sides vetting thoroughly. By end of month 5 or early month 6, legal teams finalize investment agreements. Structure: $3 FRI'd seed round, preferred equity, founder-friendly terms like reasonable pre-money valuation, information rights agreement, updates without excessive control, maybe pro rata rights for future rounds.
Closing and beyond.
Funding closes in month 6. Startup immediately implements that defined post-investment communication plan, regular updates, proactively seeking strategic input, leveraging the FO's healthcare network.
And the outcomes.
Startup gets crucial capital to accelerate product development, market entry. They also benefit significantly from the FO's deep healthcare connections, valuable pilot partnerships, increased credibility. The patient capital lets them focus on long-term, sustainable growth without immediate exit pressure, ultimately positioning them for greater success and impact.
That really brings it to life and illustrates the potential benefits beautifully. Now, one last really practical tease. For listeners seriously considering this path, can you provide some template language for a key section of a term sheet? Maybe the part outlining the investment itself, typical for a tech startup's first significant FO investment.
Certainly. Here's some example language for the core investment section. Remember, this is illustrative. Get legal counsel.
Of course.
Disclaimer noted.
Investment amount. Insert amount. The investment amount.
Name of family office. The investor.
Series seed preferred stock. The preferred stock.
Insert valuation. The pre-money valuation. Price per share. Calculated price based on amount valuation capitalization. Number of shares. Calculated number of preferred stock shares. Target closing date. Use of proceeds. The proceeds will be used for list key uses. Product dev, team expansion, sales marketing.
Investor entitled to outline rights. Example, information rights, monthly financials, quarterly updates, pro rata rights, observer seat on board.
Upon liquidation event, preferred stockholders receive typically 1x original investment plus unpaid dividends before common stock distribution.
Preferred stock convertible into common stock, 1.1 usually, at holder's option, subject to anti-dilution adjustments.
Preferred stock entitled to dividends specify cumulative, uncumulative, rate if any pari passu with common when declared by board. Conditions precedent to closing. Closing subject to customary conditions. Satisfactory DD by investor, execution of definitive agreements.
Term sheet governed by laws of state of specified state.
Company grants investor exclusive negotiating period until specified date.
That's a very helpful starting point for understanding the key elements of these investment agreements. Thanks for breaking that down.
You're welcome. Again, just a sample, but covers the basics.
Absolutely.
And before we wrap up, a final thank you again to our sponsors.
Yes.
This deep dive was brought to you by blockchaincompany.info, our media platform, and sponsored by 4IR Utility Token and 4IR GPT. To explore the 4IR utility ecosystem further, please visit 4irtoken.com. And if you're interested in leveraging your expertise through creating AI prompts, do sign up at 4irgpt.com.
Great resources. So, to summarize our really in-depth exploration today, family offices present a unique, compelling funding pathway for startups.
Definitely. Offering not just capital, but that long-term perspective and potential for strategic alignment that goes way beyond a simple transaction.
And understanding their distinct investment philosophy, their values-driven motivations, and preparing your engagement strategy accordingly is absolutely paramount for success.
Couldn't agree more.
And for you, our listener, we sincerely hope this deep dive has equipped you with actionable knowledge, practical strategies, and just a clearer understanding of the nuances involved in navigating this world of family office funding.
Yeah, hopefully empowering you to approach this exciting opportunity with confidence and clarity without feeling, overwhelmed by all the intricacies.
So consider this final thought-provoking question as we leave you. How can your startup's foundational long-term vision and deeply held core values genuinely and authentically resonate with the multi-generational legacy aspirations of a family office?
Good question to ponder.
By discovering and nurturing that authentic connection, you might just forge a truly powerful and enduring partnership that transcends a simple financial transaction, creating something really significant and lasting. Thank you so much for joining us for this enlightening deep dive.